wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And the way we do that is by first giving you a broad overview of the global markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 205, and in this episode we're reviewing the performance of the financial markets during the 12th week of 2026, and that is from Monday the 23rd to Friday the 27th of March. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where according to the Organization for Economic Cooperation and Development, the ongoing war in the Middle East and its impact on the global energy market will keep headline U.S. inflation well above the Federal Reserve's projections for this year and may possibly necessitate policy action. In its periodic update of economic conditions, the Organization for Economic Cooperation and Development forecast that overall inflation in the U.S. to be at 4.2% for 2026, and this is in sharp contrast to the prior projection of 2.8%. This is also much higher than the 2.7% that Fed officials had estimated when they updated their own forecast just last week. In its baseline forecast, the OECD said it sees the Federal Reserve keeping its policy rate flat through to 2027, reflecting rising headline inflation in the near term. Staying in the United States, Wall Street banks may finally be getting a long-awaited opening to claw back market share from private credit lenders. After a decade in which private credit lenders grew rapidly and took over a large share of financing for leveraged buyouts, signs of strain in that sector, along with easing bank rules, may now be shifting the balance in favor of the banks. Private credit is facing mounting challenges as years of aggressive lending are starting to backfire, as higher interest rates make it harder for heavily indebted borrowers to repay loans and increases the risk of default. The rapid ascent of private credit was fueled in part by a retreat from commercial banks. Following the Federal Reserve's aggressive rate hikes in 2023, banks tightened their underwriting requirements and pulled back from riskier deals. According to PitchBook data, the bank's share of buyout financing for deals above $1 billion fell to just 39% in 2023, down from about 80% in the previous 5 years. However, that share has since recovered to just over 50% in 2025. Over to the Eurozone, where European government bonds continued to sell off on Friday, building on a rout that has seen multiple countries' borrowing costs hit multi-decade highs in recent weeks. Thursday saw the yield on Germany's 10-year bond, a benchmark for the Eurozone, surge to the highest level since mid-2011, which was at the height of the Eurozone crisis. On Friday morning, the 10-year bond continued to hold above a 15-year high as it added a further 6 basis points to trade at 3.12%. And just last week, UK government borrowing costs hit their highest level since the 2008 financial crisis, with yields on British gilts spiking as investors rushed to price in a resurgence of inflation and bets on more hawkish policy from the Bank of England. On Friday, the yield on the benchmark 10-year UK government bond was up by another 10 basis points to trade at 5.07%. In the land of the rising sun, Japan's headline inflation rate eased for a fourth consecutive month in February as the economy cooled down, and this was on the back of stabilizing food prices, with subsidies shielding consumers from rising energy prices as the conflict in the Middle East rages on. According to data released by Japan's Statistics Bureau on Tuesday, the Consumer Price Index fell to 1.3% in February, down from 1.5% in January. The CPI reading was the lowest since March 2022 and was below the central bank's 2% target rate. Core inflation, which strips out fresh food prices, moderated to 1.6% in February, compared with a 2% increase in January. Over to the United Kingdom, where, according to the latest figures from the Office for National Statistics, UK inflation rate stood firm at 3% in the month of February, which marked the last reading before the start of the war in the Middle East. Economists polled by Reuters had expected the Consumer Price Index to remain unchanged from the previous month. Meanwhile, core inflation, which excludes food and energy prices, this stood at 3.2% in February and was up from 3.1% in January. This inflation print covers the final monthly period data before the US and Israel launched airstrikes on Iran in late February. The ongoing war in the Middle East and the blockade of the Strait of Hormuz has sent energy prices soaring in the recent past. The UK is particularly exposed to rising energy prices due to its reliance on oil and gas imports and the lack of gas storage facilities. On Wall Street this past week, the Dow Jones Industrial Average tumbled on Friday and fell into correction territory as Brent crude topped $110 after incidents in the Strait of Hormuz exacerbated concerns about energy supplies and as President Trump's latest comments extending the deadline to attack Iran's energy infrastructure failed to encourage traders to venture back into stocks. Friday's downturn comes a day after the Nasdaq fell into a correction and was down almost 13% below its record high that was set in October. The Dow also tumbled into correction territory on Friday and ended the session about 10% from its closing high. Meanwhile, the S&P 500 was down by 8.7% from its closing record high. For your information, a correction refers to when a stock or an index falls by at least 10%, but less than 20% from its recent record highs. And when the decline is more than 20%, that is referred to as a bear market. The 30 stock Dow Jones Industrial Average fell by 793 points on Friday to close at 45,166, whilst the S&P 500 declined by 2.1% during the week and ended the session at a 7-month low of 6,368, and the tech-heavy Nasdaq Composite dropped by 3.2% during the week before settling at 20,948. In the U.S. government bond market, the yield on the 10-year Treasury bond was relatively unchanged on Friday as investors continue to monitor developments in the ongoing war in the Middle East and assess its impact on economic data. In a Thursday post on Truth Social, President Trump said that he would extend a pause on attacking Iran's energy infrastructure by a further 10 days in order to allow time for talks on a peace deal. The yield on the short-dated 2-year Treasury note fell by 8 basis points to trade at 3.90%, whilst the yield on the benchmark 10-year Treasury bond was up by more than 1 basis point at 4.43%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, oil prices closed at their highest level in more than 3 years on Friday as President Trump's pivot to negotiations with Iran failed to ease market fears about the huge supply disruptions in the Middle East. Trump's move to pose a tax on Iran's energy infrastructure for a further 10 days in order to allow for peace talks has failed to soothe market concerns about oil supplies. Analysts now say that the market has now entered into a state of backwardation, with some suggesting that a risk premium has been baked into near-term oil deliveries due to the ongoing conflict. For your information, backwardation refers to a situation where oil contracts with immediate or near-term deliveries sell at a premium compared with contracts for much later deliveries, and this is usually an indicator that the current increase in oil prices is transitory. The price of crude is at its highest level since July 2022, following Russia's invasion of Ukraine in February the same year. The price of the international benchmark Brent crude gained by 4.2% to settle at $112.57 per barrel, whilst the price of U.S. crude, that is West Texas Intermediate, rose by 5.4% to close at $99.64 per barrel. In the precious metals market, the price of gold surged more than 3% on Friday as investors bought on the dip following a pullback earlier in the week, whilst at the same time looking for signs of de-escalation in the Middle East conflict. The ongoing war, which is now in its fourth week, has spread across the Middle East, hitting the global economy with higher energy prices that have fueled concerns about inflation. Rising inflation has shifted the Federal Reserve's outlook towards potential rate hikes, and this typically weighs down on the price of gold as it increases the opportunity cost of holding this non-yielding asset. According to the CME's Fed Watch tool, traders have now fully priced out any US rate cuts in 2026. The price of spot gold recovered from a 4-month low hit earlier in the week and managed to rise by 3.6% on Friday before coming to a close at $4,536 per ounce. We now change scene to the Kenyan financial markets. And as usual, we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling continued to slide versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.72 compared to a rate of 129.52 the previous week. Meanwhile, the sterling pound was priced at 173.74 and the euro was valued at 150.30. And on the regional front, one Kenya shilling was changing hands for 28.55 Ugandan shillings and 19.84 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.25. The IMF has previously raised concerns about the extreme stability of the Kenya shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by $272 million for a grand total of $14.02 billion, which is equivalent to 6.0 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The recent increase in forex reserves was attributed to the issuance of a dual tranche Eurobond for $2.25 billion, part of which was used to buy back existing Eurobonds that are approaching maturity. But despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained well-funded and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka KESONIA, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate increased by 5 basis points from 8.68% to 8.73%, which is in line with the revised central bank rate at 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 9.6 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 26th of March, and the central bank received bids totaling to 10.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 45%. The central bank ended up accepting about 10.8 billion shillings, and the results of the auction were as follows. The 91-day rate dropped by 14 basis points to settle at 7.42%, whilst the 182-day rate dipped by 1 basis point to hover at 7.82%, and the 364-day rate fell by 6 basis points for a weighted average rate of 8.28%. In the primary bond market, the Central Bank of Kenya has published a prospectus for the reopening of 2 fixed coupon treasury bonds in which it is looking to raise a total of 40 billion shillings for the stated purpose of budgetary support, and whose terms and conditions are as follows. For the first bond, this is a 15-year bond with 8.9 years left to maturity and a coupon rate at 12.75%. And for the second bond, this is a 25-year bond with 17.3 years left to maturity and a coupon rate at 13.40%. Please note that these bonds are now open for sale until Wednesday, the 1st of April, when the auction will be held. And in the secondary bond market, the Central Bank of Kenya has published a prospectus for a switch auction in which it is inviting investors in the source bond, that is FXD1/2016/010, which matures in August 2026, to switch their investment to the destination bond, which is FXD1/2018/015, which is a 15-year bond with 7.1 years left to maturity, and that means that this bond matures in May 2033. Please note that the offer to switch is now open until Monday, the 13th of April, when the auction will be held. At the Nairobi Securities Exchange, the 5 largest firms at the Nairobi Exchange have lost about 200 billion shillings in valuation since the start of the war in the Middle East, as foreign investors remain net sellers. Foreign investors have sold a net position of 4.2 billion shillings worth of shares on the Nairobi Securities Exchange and are opting to hold on to cash due to fears of global inflation and recession due to the ongoing conflict. The 5 largest listed firms have high exposure to foreign investors due to their stable fundamentals and ample liquidity. These firms account for about 60% of investor wealth at the exchange, with changes in their share price having a significant impact on the overall performance of the market. Up next is our topical issue, and this week we are looking at the following 2 issues. The first is the shift by Gulf oil companies to India and Belgium in order to maintain fuel supply to Kenya. Kenya has an agreement for the supply of petroleum products with 3 national oil companies in the Gulf, namely Saudi Aramco, Abu Dhabi National Oil Company, and the Emirates National Oil Company. This agreement is under a government-to-government contract which has been in place since March 2023. However, the ongoing war in the Middle East has forced a change in transport logistics, and in the process, India and Belgium have now emerged as key alternative sources for Gulf oil companies as they seek to sustain the supply of petroleum products to Kenya amid disruptions to the traditional transportation route through the Strait of Hormuz. The second topical issue is on crypto firms looking to enter the Kenyan market. More than 50 digital currency firms, including the world's largest cryptocurrency exchange, that is Binance, these companies are in talks to set up regional headquarters in Nairobi. The crypto companies are attracted by the growing adoption of digital assets in the country and the tax incentives offered by the government, as Kenya seeks to position itself as East Africa's leading financial hub. The Nairobi International Finance Center revealed that it was engaging with crypto firms as part of a push to attract investments into the country and to create jobs for a vibrant and well-educated youth population. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember do the best you can until you know better. Then when you know better, do better. A quote by Maya Angelou. Think about it. Thank you, and God bless.